You're like a majority of Americans. You have student loan debt, you have credit card debt, you have unsecured debt, you have auto loan debt, you have mortgages. This is eating up your entire income, guys. You have to systematically go through paying off and consolidating debt, getting rid of it once and for all, and making sure that you are not accumulating new debt. Now, having a lot of debt makes life incredibly difficult. A lot of Americans are living paycheck to paycheck because of the outstanding debt. Not only are they strapped for cash, but when it comes to building an emergency fund, qualifying for a mortgage, even having a down payment for a home, it can be incredibly difficult. Today, we're going to be looking at 6 ways again to consolidate and really get out of debt. Number one being paying more than the minimum amount. Now, when it comes to credit cards and you look at your statement, regardless of what the balance is, you'll see most of them say 10, 15, 19, 22 years to pay off the credit card debt, which is just insane, guys. It is literally insane the amount of years and the amount of time with the minimum payments they have on cards that you're actually going to pay it off. Now, coupled with that, again, we have seen the APRs on the credit cards, the annual percentage rate, increase dramatically, going over 20% on a national average, which means the money that you borrowed at a much lower rate is now a much more expensive rate. So paying more than the minimum really makes a difference, but there is a way to systematically do this, which is going into number 2, our debt snowball. So creating a debt snowball, really aligning your debt and lining them up, guys. Put all of your balances down on a piece of paper, on a spreadsheet, whatever it may be. Not only what you owe, how much you owe, and what the rate is. Systematically, we are going to go through there and knock it out with the debt snowball. So the way that we do this is listing all of your debts from the lowest balance you have. Let's say you owe $500 on a credit card, to the highest balance you have. Let's say you owe $30,000 on your auto loan. We are systematically going to knock out the first one. So every single debt that you have, you're going to make minimum payments. Every single penny above that minimum payment, you're going to use to knock out that lowest balance. So on and so forth, guys. Once that first $500 is gone, you're going to roll that into the next one, into the next one, into the next one, until you have a giant payment snowball that is knocking at the door of that auto loan, which was at 30K, and knocking that down, making sure you're getting rid of this, guys. A lot of people also use the debt avalanche, which this is kind of the opposite of the snowball. So this does the same thing, lists all of your debts, but this time you do not worry about the balances, you worry about the APRs. Mathematically, this makes sense. Where the debt snowball makes sense logically and psychologically, the debt avalanche, again, is built a little bit different when it comes to fundamentally wiping out the cards with the highest APR. So it is essentially the debt that is the most expensive in your life and systematically knocking that out. But like I said, guys, a lot of people like the avalanche because, or like the debt snowball, because you have the psychological factor, where the debt avalanche is the logical mathematical factor. Number 4, looking at consolidation loans. Now this, as much as I do like the consolidation loans, there is one big caveat to the consolidation loans. Is most of the consolidation loans, so let's say over the last couple of years, we've dealt with COVID, a couple of unexpected expenses. Let's say there was a job loss in there. You've accumulated $10, $15, $20,000 in credit card debt, which now you're ready to move it over to an unsecured loan. That is great. The APR is going to be much lower. It's going to make sense to move it over to that unsecured loan if and only if the behaviors and the budgets are there, which means now you're going to have that unsecured loan and that unsecured loan payment. A majority of Americans rack up the credit cards that they just consolidated. Within the next usually 3 to 5 years, we see people doing consolidation loans again because they are not budgeting the expenses that they have, and it just comes from overspending. Now, personal loans, you can get 7, 8, 9% depending on the amount, the term you're looking for, which again, when you compare it to the 20+% of credit cards, can save an incredible amount of money, and systematically, it can make it easier. For instance, the same example we used before, let's say you do have 5 or 6 credit cards, you can consolidate all of those into a much lower APR with one single payment. That is going to be the focus to get rid of, guys. If you're taking that out for, let's say, 3 or 5 years, if you can pay it off in a year or two, you're going to save not only a lot of interest in there, is you're freeing up cash flow because you no longer have that payment. Number 5, signing up for a balance transfer. Now, balance transfers, of course, can have a 0% APR for 18 months, 24 months, whatever it may be, but you have to be super careful with these guys because the majority of them have a 3 to 5% balance transfer fee, which can just add on. So if you're rolling over $20,000 and they're hitting you with a 5% balance transfer fee, yes, the APR for that time is going to be a little bit lower, but you have to calculate mathematically exactly what it's going to offset. So are you going to make essentially what you're saving up in APR? How many months is it going to take you to cover what you had to pay in a balance transfer fee? Kind of what are you going to do? Also, making sure that you have a way to pay this off, guys. Now, I see individuals that are going from balance transfer to balance transfer to balance transfer to balance transfer over years and years and years. However, during the balance transfer phase, not only are they being charged that 3 to 5%, but they are not paying down the balances, which is huge, guys. That is where people get stuck in this endless debt cycle of the unsecured, the credit card advances, the credit card balances, the limits on there. They will continue to borrow you money as long as you're paying those, because they know that they are going to be getting money in return as financial institutions. Number 6, boosting your income. This could be short-term, this could be long-term, whether it is getting a raise at work, whether it is taking on a part-time job, a side gig, a side hustle, whatever you want to call it. There are a ton of different ways to make additional income to really pay down the debt faster. But again, these do not work unless you are fundamentally budgeting well within your means, using the 50-30-20, using the zero-based budgeting, making sure that you are making more money than you are actually spending during the month, during the quarter, during the year. That way you are net positive for the money you're bringing in. If you're running a systematic budgeting system where you are running in the red, or you are spending much more than you are accumulating or that you are earning, it's never going to work, guys. There is going to be a point where you do run out. Either banks are not going to let you borrow anymore, credit cards are going to be maxed out, or your credit score is going to be affected where you cannot get additional loans at that point. Again, boosting your income, looking at side jobs, looking at side gigs, part-time consulting work, teaching, whatever it may be, guys. The ability to boost your income can go ahead and knock out a ton of debt really fast, using all of the additional income that you're earning to actually put those down. But like I said earlier, with the debt consolidation, you have to be very careful with it, guys. It's a good deal, and it is really worth it if you are budgeting properly. If you're budgeting not only for the payment, but the time you're going to pay it down, and you're not accumulating new credit cards. That is right, guys. You have to stop digging the hole. That is the biggest thing that we see. Most of the people, like I was saying, that do the consolidation loans, we see them every couple years doing the exact same thing, because they don't have the fundamentals within the budgeting system to make sure that they're not accumulating any of the new debt that we see. So, all right, guys, so that'll do it for today's video. Let me know in the comments what you guys think about the debt consolidation and how to get out of debt a little bit faster. And as always, thank you guys for watching.